David Palmer, Evercore ISI Senior Managing Director, Restaurant Packaged Food Analyst, joins us this morning. David, as a buy, target of 330. What do we make of it, David, when management says the consumer is price weary?
Yeah, it was a sobering quarter for sure. Probably one of the most sobering we've heard in quite some time. The industry has definitely flattened out. Traffic's negative out there. Pricing's been rolling off and things aren't getting better. A lot of players out there are talking about the under 50,000 household income cohort. That's about a third of fast food users. It's more than that for a player like McDonald's. And that's the group that's dropping out. They're the ones that are struggling with all that inflation over the COVID period and probably some other things like interest rates and a lack of some of the wealth effects that are hitting other income groups.
So what would take you to 330? That would be an all-time high, right, in 12 months?
Yeah, it's going to have to be from adjustments. You know, these guys are the big guys. They got $1 billion in national advertising spending, and they say they're going to push that towards the value message. The tricky thing, and we're going to learn more about this in the coming weeks, the tricky thing is how do you do that national, entry price point value when you got $20 labor in California? How do you unify a message around something that's compelling in the Deep South and the coasts when many of those labor rates and therefore pricing spending power is different? And so that's going to be the big challenge for these guys. But, if you go back to the last recession when there was much more daunting challenges than this from an industry perspective, McDonald's came out ahead because they did have the muscle and they had the cash flow for the franchisees to afford a bigger value message.
Meantime, some chatter about a larger burger this morning, which got the tape's attention. Can you address that in terms of CapEx, R&D for franchisees, kitchen complexities, throughput, stuff like that?
I think you're talking about the third-pound burger that they're talking about. Yep. Perhaps for 2025. That's something they've been thinking about. I think in the near term, one of what they're going to be focused on is more mid-priced value. I know the franchisees are asking for the McWrap as something that could be under $3, spicy McChicken, items like that could really help them access that lower price tier. But there's going to be a role for premium innovation too. As we've noted, there's certainly more strength among that income cohort. But they just right now, first things first, they need to stabilize traffic, which is down pretty significantly in the industry. And it's really being driven by that value user that is dropping out more than it's dropping in from trade down.
Right. So that was my question, was why is traffic down? Shouldn't this be a good environment for McDonald's when there is pressure on the low and middle income consumer, when there is inflationary pressure where people are looking for good value and good deals? Shouldn't this be like McDonald's moment? Yes.
Well, what's happened is sort of a magic combination of things, or really the inverse of magic for them, in that there's been something like 30% inflation in both food away from home and food at home. And that is more damaging to the price gap for food away from home because that's about 4 times higher than the food at home. So you have a kind of a penny price shock that's now coming about. At the same time, supermarket price inflation on a year-over-year basis has crossed below that of restaurants. And so those two things have created these cosmetic issues. You probably heard on Twitter about people talking about all the price shock at McDonald's. So these guys have to grab the narrative and change that with some nationally advertised value. But because right now it looks like all of restaurants is not a good value right now because of all the inflation that happened.